Let's get you to the weekend. Live from New York City this morning. Good morning, good morning. Equity futures pulling back just a little bit on the S&P 500. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, UAW hitting Detroit's big three with strikes. Automakers conveying their extreme disappointment as we wait to hear from a pro-union president. We begin with the big issue, strikes in America.
We have greater strikes.
News that we're seeing about, the strikes.
The auto workers' strikes.
The UAW.
The UPS.
The strikes around riders in Hollywood.
Power is still in the hand of a worker.
Labor does have some more power now than it used to.
It's still a very tight labor market.
The labor markets have been tight for 2 years or so.
This could, again, be a weight on the economy and on the labor market.
You're going to have ongoing pressure with wages and inflation.
The risk that we do get that stickiness still in wage growth and inflation.
I'm not necessarily convinced that this is kind of the dying embers of a hot labor market.
Has the labor versus capital pendulum swung for real?
We are starting to reach an inflection point that should put the labor market into a little bit more of a balanced state.
Team coverage starts right now with Bloomberg's Anne-Marie in D.C. alongside Keith Norden in Detroit. Keith, talk to me about how far apart are the Detroit's big three and this union.
They are very far apart. On the wage offers, the union has brought theirs down to a request for a 36% wage increase, and GM and Ford are offering a 20% wage increase. So there's a wide gulf.
AMH, the President of the United States, set to address the country later on today. Any idea when and what he's going to say?
We don't have a time yet, Jonathan. That's yet to be determined from the White House. But what we do know is that a month ago, the president put out a statement. He talked about that he wants to see a just transition to a greener economy. What you see this Friday morning is two of the president's key policy goals at loggerheads. One is a move towards electric vehicles. The other is to maintain that he is the most, what he likes to call himself, self-described, most pro-labor union president in history. What you see from President Biden is that in front of the cameras, he's going to want to have that rhetoric to make sure that he is fighting for labor unions. At the same time, behind the scenes, what you likely are going to be hearing about and leaking from the White House is that they've been on the phones with everyone, the labor union and the companies, to make sure they could try to find an agreement. Jared Bernstein said this week they are encouraging both of these parties to remain at the negotiating table.
Keith, let's talk about strategy. 12,700 workers across 3 plants. They're not going after the Ford F-150s of this world. Talk to me about the strategy and what's left in their back pocket if they want to escalate things.
Well, they certainly have gone after key plants. You're right, they haven't gone after the big pickup truck plants that are the most profitable. But these 3 plants make hot-selling products. The Ford plant makes the Bronco SUV, the Stellantis plant makes the Jeep Wrangler, and the General Motors plant makes the Chevy Colorado, a mid-sized pickup truck, all hot sellers, all profitable. But yes, they've left the door open to ratchet the pressure up even more by going after the big pickup trucks that make the most money for the companies.
Keith, any idea of what kind of number gets this deal done?
There is such a wide, divide between the ask and the offer from the companies. So it's clearly something north of 20%, but the companies say they can only afford so much. They're spending collectively more than $100 billion on their new EV programs. So they say they can't spend 36% or it will bankrupt them.
AMH, just finally, would you expect to see more Democrats on the picket line with these strikers?
Well, Jonathan, I think how Democrats would like to describe themselves if they are pro-union is that they want to be the voice of working people within the government. This is what Seth Harris said to us last night. He was Biden's former aide when it comes to labor unions and helped him coin that term that we continuously hear from the president. But likely you will see some congressmen and women from Michigan that are going to come out and talk on behalf of the UAW. At the same time, Jonathan, you have to remember Elected officials are dealing with constituents that are very concerned about higher inflation. What Anderson Economics says is that this could be a $5.6 billion drop in the bucket of lost profit if it's a 10-day strike. This could mean the difference of Michigan having a soft landing or a recession. This is a key state that Democrats need to keep control of next November.
AMH, great to catch up, as always. Anne-Marie from Washington, Keith Norton over in Detroit. Detroit shaken by strikes on all three automakers, GM, Ford, Stellantis. With us around the table here in New York, I'm pleased to say Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, good morning to you.
Good morning, John.
Question that has dominated this programme now for weeks, and I'm going to repeat myself once again. Is this the dying embers of a hot labour market, or do you think this is here to stay?
I think this strike is here to stay for a while. Ask yourself two questions, a macro question and a micro question. A macro, why did it take so long? When you have a combination of a very tight labor market on the one hand and workers being hit by an unanticipated bout of inflation, you normally get catch-up wage negotiations. But it took much longer here than it took in the UK, for example. So why did it take so long? And then from a micro perspective, if you're a UAW worker, if not now, when? This is your key point of bargaining power. Your bargaining power is going to erode over time. So if you're going to strike, now is the time to strike.
Doesn't this just accelerate the move away from labour in places like Detroit? Is this the last big contract negotiation the likes of UAW are going to have?
So I would put it the other way. It stops the shift from labour to capital, and it provides some opportunity for the shift to come back a little bit. We've had a massive move from labor to capital over the last few decades. And now we're seeing not that stop, and there is a possibility, and I would say there's a desirability in seeing it come back a little bit towards labor.
And a big shift towards labor potentially, given some of the demands. Any idea of what kind of numbers gets this done? It started at 40, they dropped to 36. Clearly nothing in the low double digits gets it done. What gets it done?
I don't have a feel for it, but it's not just that number. It's also other working conditions. This is an opportunity for the AAW. The big question for all of us, looking at the economy, looking at the markets, will it have demonstration effects? Will it be a catalyst for many more strikes in the US, like we've seen happen in the UK?
Union membership is low in America, so if there is spillover to unions, maybe it could be limited. I'm thinking about the signalling beyond unions. When I see headlines like UBS, when I see headlines like American Airlines, when I see headlines like this, whatever the deal is going to be, it's certainly going to be north of 10% based on what we're hearing. Don't I just go into negotiations at the end of the year, sit down with management and say, you know what, I want some of that?
Yeah, you do. The real question is, do you say, I want some of that, meaning I want to regain some of the wages I lost due to this unanticipated inflation? Or do you also say, I'm anticipating future inflation and I want something more than that? So far, I think it's limited to the first, but if that second one happens, alarm bells would be ringing at the Fed.
Big question for the Fed. Do companies eat this through margins or pass it on?
Depends what happened to the economy. So far, companies have been able to pass it on. The big mistake the Fed made in 2022 is not realizing that companies will quickly pass on what they thought were once and for all and reversible increases in costs. So we're going to see this again. And it's not just labor, it is also energy. So this is another bout. For those of us who lived through the 70s, we remember that there were 2 oil shocks. 2, not 1. So think of this as being potentially a second, much smaller shock. And it will be interesting to see how it proceeds.
Labour market power on the table, crude in the 90s. If you're at the Federal Reserve next week, what are you thinking about all of this?
So they'll pause. I don't think at this point they can hike, but they'll keep wide open the possibility of another hike, and they're going to push back against this notion that they'll be cutting anytime soon. The message will be, we're going a little bit higher, and we're going to stay there for longer.
Should they worry about $90 crude? If it's just a supply shock, should they worry about that?
They should. Otherwise they're going to repeat the same mistakes they made in 2022.
Which was?
Which was to think that this is isolated, to not realize that there are spillover effects. The big hope, the linear disinflation argument, was goods were disinflating, and in some cases prices were falling, energy. Services were inflating, but if you wait long enough, services will start to disinflate as well. And the fear was that goods would start inflating. Now we're seeing goods are going to start to inflate. And that's, I suspect, will keep people up in Washington, D.C.
I was trying to tee you up to use the word transitory, the T word. That's the question people are asking now. Is this disinflationary trend of the last few months transitory?
No. Transitory isn't a time concept. It is whether it changes behaviors. Something is transitory if you believe it is temporary, it's reversible, therefore you should look through it. It doesn't change your behavior. When these sorts of news start changing people's behavior, then it's not transitory.
Mohammed, you're going to stick with us more on the Federal Reserve and much more on this energy market move as well. Equities pulling back by about 0.2% on the S&P 500 this morning. With some movers, here's Abby.
John, let's take a look at two of the big automakers that are reacting to some degree to this unprecedented strike, by the UAW. We have Ford down 1.8%. GM is also down, not shown, but Stellantis is up 0.5%. So it's interesting to see that the surgical and uncertainty that they're creating by the strategy that they're going after is creating these mixed moves for stocks. Stellantis on the year up more than 30%. Ford is up just about 5% on the year. Adobe down 3.6% this morning. They beat estimates, but their guidance is a little bit light. That stock on the year, John, up more than 60%. Investors wanted perfection from the software maker. They didn't get it. The stock is down.
Abby, thank you. Coming up on this program, energy taking the blame.
Whether it's grain, whether it's oil, whether it's gas, we're looking at all those components very, very carefully because some of them are volatile, some of them are on the way up, and they will have consequences on prices.
That conversation up next.
Whether it's grain, whether it's oil, whether it's gas, we're looking at all those components very, very carefully. Some of them are on the way up, and they will have consequences on prices. We had a good scenario analysis produced by staff about China and the role that China growth or deceleration of growth would have on our own GDP and our inflation. That, combined with the price of oil, is obviously something that we need to be attentive to.
ECB President Christine Lagarde highlighting the energy sector, which is quickly becoming the culprit for absolutely everything this week. US retail sales and producer prices coming in hotter than expected, fueled by higher gasoline prices. Auto workers going on strike, the union nervous about President Biden's robust EV transition, eliminating jobs, and a number of US airlines slashing their outlook, all placing the blame on rising fuel costs. All of this no surprise to Jim Bianco, who wrote a few weeks ago, quote, crude oil and gasoline prices are about to take center stage. They take center stage right now. Jim Bianco joined us from Bianco Research alongside Mohammed Al-Arian here in New York. Jim, you said it. Here we are, $94 crude. What does it change?
I think it changes a lot because while we look at the reduction in supply and we look at the voluntary cuts of OPEC to blame that for the higher prices, let's look over at the demand side. And demand is booming. And demand is booming in oil, and we've got at the same time very weak growth in China. So we're seeing probably a transition from transit commuting to auto commuting, and it's also maybe an underlying sign that there's going to be no soft landing or hard landing in the economy, maybe a no landing because of this continued strength. As long as we have this cocktail of strong growth or strong demand and we have voluntary cutbacks, I think the price of oil is going to keep going up, the price of gasoline is going to keep going up. And the final thing is, I think we're a ways away from demand destruction. We're at $3.87 a gallon nationally in the U.S. I don't think it's $4 that's going to start demand destruction. I think it's much, much higher, and that will first foster into much higher inflation before we start talking about demand destruction.
Hey, Jim, this is really important. This goes back to one of my favorite questions at the moment. Do you view this, then, as a reflection of the extension of the cycle and not a recipe to end it?
Yes, I do view it as an extension of the cycle. I've always been of the opinion that we're in a post-pandemic economy. Big fancy word for meaning that shutdown restart of the economy in 2020 was the most important economic event of our lifetime. When we rebooted the economy, it did not come back the same. That doesn't mean dystopian or worse. It means different. And we've got this chronic shortage glut cycle as we try to figure out what this post-pandemic economy means. And this is more of the same, whether it's the China slowdown, it's the gasoline, or it's even the strike with the UAW and the Hollywood strike and nearly the strike with the freight trains and the West Coast ports, and all of a sudden the movement in labor that we're seeing, it's all part of that same mosaic that the economy has fundamentally changed since 2020. Not worse, changed, and we still haven't quite figured out what that is.
Jim, you put forward two hypotheses. One is that oil and gas prices are going higher, and two is that demand destruction will take time, which raises a very important question. What's your feeling about the pass-through? How much of this is going to spill over into a wider price impact?
I think it's going to spill over into a wider impact. I think that the attitudes have changed. I wouldn't quite go as far to say that, inflation expectations are unanchored, but let's say they're loosening as we move forward. I'll remind us back in 2021, when Procter & Gamble raised prices, they announced it in March. They said it would take place in September, and they said that in the interim, they'd write a white paper to explain why they were raising prices. That's how epic it was to raise prices 2 years ago. Today, we just raised prices. And so we've loosened the anchor a little bit. And I think if oil prices keep coming up with that loosening anchor, we're going to see this getting passed through, not just at the pump, but in transportation costs, delivery costs, input costs. It's going to be problematic, I think, up and down the line.
So if you are sitting at the Federal Reserve and you agree with your three hypotheses, oil going higher, no demand destruction, and it will be passed on, what would you do?
Well, I've been a bit more hawkish than the consensus. I think that they're going to raise rates in November, and I don't think that that's going to be the last rate hike. Now, the next one might not come until 24, but even if there isn't another rate hike, I think the idea that there will be multiple rate cuts in 2024 is premature. The only reason the Fed would cut rates in 24, I think, is if we saw a recession, a full-blown out hard landing recession, and they responded to it. Short of that, I'm in the higher for longer camp, and I'm not even sure that one more rate hike is really done, and that's the way I'd be looking at it.
So, Jim, you've got to make a bond market call off the back of that analysis. We've got a 10-year in the 430s, a 30-year around 440, a 2-year still in and around 5% right now, up 2 basis points on the day. What's the bond market call?
I think the yields are going to continue to head higher. I don't think that the cycle is over. Well, let me back up and say that yields bottomed in August of 2020. I think that ended the 40-year bull market in bonds. We're in a multi-year bear market in bonds. We're in year 4. August of 23 started year 4 of it. We're only 3 basis points or 4 basis points in the 10-year from another 16-year high. And I think that those rates were going to continue higher. Now, there will be fits and starts. There will be rallies. There was a huge rally in the bond market off of the Silicon Valley Bank failures in March. But then we turned around and completely reversed that by the end of the summer. And so I do think that irregularly rates are going to go higher. I think irregularly that the yield curve is going to at least stay at its current space or maybe even flatten or get more inverted, because ultimately I don't think the Fed is done with one more rate hike. So I'd have a very defensive position in the bond market right now regarding rates.
Jim, if that's the call and if you're right, where's the rest of the world? Where's Europe? Where's China?
Well, I think that there's a little bit of a split between China and the rest of the world. If I'm right, and the problem is that we've got sticky inflation and a post-pandemic economy. That's global, and that's going to impact everybody else. And we're seeing that whether you're talking about Japan or Europe, higher inflation across the board everywhere. We're seeing higher rates across the board everywhere, and I think we're going to continue to see those rates moving higher. China's a little different story. They're on a different cycle. They're decelerating. They're going down in terms of their economy, and I might add, it's really surprising that after they opened from zero COVID at the beginning of the year, their economy just kind of was a dull thud on the floor in terms of its pickup. So that might be something different. And because they're in a different cycle, I don't think that the spillover effects from China, there will be some, won't be nearly as great as people fear. So I think globally we're going to continue to see higher rates as well in an irregular pattern, but they're going to keep going up.
Hey, Jim, fascinating call. Jim Bianco there of Bianco Research. The last 24 hours has been so busy. China cut the reserve requirement ratio and we barely talked about it. Mohammed, quite a call there from Jim. the idea that this is going to stay, that the data is going to continue to surprise into the upside. We had industrial production out just moments ago. That came in hotter than expected at 0.4%, the estimate 0.1%. Do you get the sense that this economy still is more resilient than people are giving it credit for?
I do. I think the U.S. exceptionalism when it comes to economic activity has been remarkable, and it's going to stay for a while. There is a lot going on that is good in this economy. Now, we could hit a pothole. There's no doubt about that. Jim pointed to one possibility, which comes from the energy prices. Another possibility is a government shutdown. A third possibility is the Fed making a policy mistake. But left to its own devices, this economy still has momentum.
Jim's not alone. Others are out there saying the same thing. Bill Dudley, the former president of the New York Fed, a guy who you know well. Remember that conference we did together back in the summer of 2021, and you were both saying this inflation story is real? He was talking up 5% interest rates at the Federal Reserve. He's now asking the question as to whether we've already seen all of the lags from policy. They're done. They hit the economy, moving on and accelerating again. Where are you on that?
So there are so many uncertainties about monetary policy right now. You know, Chair Powell said at the end of his Jackson Hole speech something along the lines of, we are looking at the stars, we are guided by the stars in a cloudy sky. I think that was the phrase. Well, if you look at the sky, at the stars, they're all moving. No one knows where our star is. No one actually knows what the right inflation target is, and no one knows what the right monetary policy framework is. And then if you look at the clouds, there's massive disagreement on, have we seen the last of the lagged effects, or they're still to come? There's massive disagreement on what will QT do on top of all this, and people disagree on whether it's the level or the change in rate that is in the driving seat right now. So there are so many uncertainties. I listened to Bill Dudley really carefully.
Yep.
The major pushback against Jim's view and Bill's view are those who believe in technicals. Those that believe that there's a ton of money waiting at the short end of the curve and looking to extend once we get to 435, 440 on the 10.
Mohammed, stick with us. Coming up, the morning calls, and later, Cboe's Mandy Zhu joins us at the opening bell as stocks look to rebound from last week's declines. From New York, this is Bloomberg. Equities a touch negative. Let's get you some morning calls. First up, Piper Sandler upgrading KeyCorp to overweight, highlighting the stock's compelling valuation and easing funding concerns. Your second call comes from MoffettNathanson, downgrading DoorDash to market perform, expecting the resumption of student loan repayments to weigh on future bookings. And your third and final call from Redburn, upgrading Estee Lauder to neutral, seeing limited downside and strengthening fundamentals. Up next, Cboe's Mandy Zhu joins us at the opening bell and why the fear gauge is trading near 2020 lows. The opening bell up next. "24 seconds away from the opening bell this morning. Good morning to you all. Heading towards a week of gains on the S&P, pulling back just a touch on futures, down about 0.4% on the Nasdaq. A similar move. The big story in Detroit, a strike on all three: GM, Stellantis, Ford. Those three names doing okay in the pre-market. We'll talk about how they perform coming out the other side. There's your opening bell. Switch at the board and get to the bond market. Yields look like this on a 10-year, higher by a couple of basis points at 430.65. In foreign exchange, the dollar stronger, potentially for a 9th consecutive week against the euro, a record weekly run. This morning, the euro just a touch stronger by 0.2% at 106.65. And crude had a little look at 90, then pulled back. WTI, 89.35 and negative 0.9%. About 25 seconds into the session, we're down a third of 1% on the S&P. On the Nasdaq, we're down a third of 1% also. One sector to watch at the open: the automakers, GM and Ford, under pressure as the United Auto Workers start striking at select locations. UAW President Shawn Fain saying this strategy will keep the companies guessing, and if we need to go all out, we will. Abby has more. Hey, Abby.
Hey, John. It does seem that confusion and uncertainty are one of the biggest goals of the UAW in terms of this strike strategy. Some experts saying that it is probably one of the least painful ways that they could stage a strike against the big three automakers. Although, of course, it is unprecedented in the fact that they are striking against all three at the same time. Now, on Friday, today, at midnight, workers walked out of the three plants, one from each of the big three companies in Missouri, Michigan, and Ohio. It's being called a stand-up strike, and this is the strategy of the UAW, that they can call up other members of the UAW to stand up at every time and create logistical, surgical, tactical problems for these automakers. Right now, it's less than 10% of the UAW's 145,000 members that have walked out. And again, to create the uncertainty for the big three. But for the stocks, John, there's not so much uncertainty. I would argue GM down 0.6% and Ford down 1.4%. It could be much worse if investors were really nervous. Now, that said, each of these stocks, including Stellantis, down between 10 to 20% from the July peak. So some of this is priced in. We've been talking about this for a while. And although the gap between the UAW and the automakers for a pay raise is wide, 20% to 36%, some are saying the fact that the UAW hasn't gone for the jugular, it may mean that there could be some sort of a deal in the works.
Abby, thank you. Let's see if we can close that deal sooner rather than later. Tesla might be loving what we're hearing. Dan Ives of Wedbush expecting one automaker in particular to benefit from the work stoppage, writing this: the clear winner in this Game of Thrones battle between the UAW versus the big three is Musk and Tesla, with Champagne now on ice, which sits in a non-union position, and its biggest potential EV competitors now face mounting costs and complexities in the years ahead, depending on how this ultimately plays out. Tesla this morning positive through much of the day. Turning to the media space, Disney is said to have had initial talks to sell its ABC network and other stations, the company writing in a statement, "While we're open to considering a variety of strategic options at this time, we have made no decision with respect to ABC or any other property." Simone Foxman has this one. Hey, Simone.
Yeah, it's not just Nexstar, also potentially Byron Allen, who Bloomberg has reported, and we've been all over this story, has offered $10 billion for ABC TV network, local stations, as well as FX and National Geographic. While the company might not have made any decisions, though, analysts are already trying to pick through exactly what this would mean, both for Disney and its potential acquirers. And the commentary pretty mixed. Bloomberg Intelligence estimating that selling ABC and the local networks could potentially bring Disney $4 billion. Rosenblatt Securities believes this could be great for breakup value argument for Disney's equity, but it would be risky for Nexstar, whose shares rallied yesterday. KeyBank, however, saying that selling ABC would be negative for Disney because it would likely be done on a highly dilutive basis. And the interest in selling implies that Disney soon thinks pay TV will implode. The assets on the block, the idea, not completely surprising. This is something that CEO Bob Iger had hinted about back in July. But with Disney looking closing at its lowest since 2014 on September 7th, we're seeing some positivity in the shares today as everyone reacts to this news, John.
Simone, thank you. Let's turn to the semis just briefly. ARM seeing a successful day, first day of trading, jumping nearly 25% in that debut. Needham initiating coverage on shares with a neutral rating and writing this: ARM can grow by capturing greater value from smartphones, but not enough support upside from the stock's IPO valuation. Shanali Basak following this one. Hey, Shanali.
John, you might have heard about it. It's the AI frenzy, and you have ARM feeling the heat of it. Remember, when you look at Thursday, retail orders into Fidelity surpassed 20,000 orders for ARM. So you do have retail investors and institutions alike pouring into the stock. And today, when you look at it, have a second day of trading higher, you could say something today that you couldn't say yesterday, which is that ARM is finally valued above where SoftBank repurchased its stake for just a couple of weeks ago. That was at $64 billion. Now it's closer to $70 billion. But now its valuation alone is on the list of the risks that ARM faces ahead. That includes its nearly fourth of its sales tied to China and the risks tied to geopolitical risks in the chip wars, as well as declining smartphone sales, as well as profit alone, even at ARM facing pressures in the most recent fiscal year. Those are the list of risks that these investors face ahead. But today, yesterday, and into next week, as we face a whole horde of IPOs ahead of us, this so far is not an issue.
Shanali, thank you. The stock up again by 3.8%. Turning to Adobe, the software company delivered a mild sales forecast despite the optimism in AI. The CEO saying this: "We are unleashing a new era of AI-enhanced creativity around the world with innovations across our product portfolio." Isabel Lee on top of this one. Hey, Isabel.
Hey, John. So just like a lot of other companies, Adobe has been getting a lot of mileage out of AI, but over-optimistic investors are just wanting for more, which is why even if sales forecasts meet expectations, we see shares slumping to around 5%. So here are some numbers. Sales will be 4.98 to 5.03 billion in the period ending November. Analysts were expecting around 5 billion on average. Profit excluding some items will be as much as $4.15. So that's 9 cents higher than estimates. So Adobe is adding generative AI to a lot of its products, and they will be increasing those products beginning November. And analysts expect this new increase to lift revenue quickly. We have William Blair expecting that it will add around 600 million over the next year, and Bloomberg Intelligence projects a 10% sales increase in the first year. But of course, there's a flip side for everything. Some express caution that the price increase would affect demand, John. But for now, Adobe has rallied some 60% year to date.
It's just down this morning by 4%. Isabel, thank you. Joining us now to discuss this market, Mandy Zhu of SIBO Global Markets alongside Mohammed Al-Arian. Mandy, let's get straight to it. The VIX, you know the complaints. Has it become totally irrelevant?
We don't think so. I mean, I think the decline in the VIX obviously has puzzled a lot of investors this year, but I would say it's really a reflection of the change in the macro environment, right? So when we started this year, the consensus among economists, among investors was very much, recession risk in the US. And now as we stand here, 9 months later, the consensus has turned into a soft landing. And that's why the decline in volatility has really been across asset classes. We're seeing it in FX, we're seeing it in rates, we're seeing it in commodities, in credit. It's really in line and in sync with the other asset classes, which suggests to me that it's very much macro-driven rather than anything equity-specific.
That's your observation. Let's get your judgment. Do you think those soft landing hopes and dreams are relevant? Do you share them?
Look, I mean, there's clearly still a lot of risks, going forward. And I think that's why starting to see a pickup in option volumes in VIX, particularly investors coming in to buy those VIX upside calls and call spreads. VIX option volumes are actually on pace to hit a record this year, which I think surprises a lot of people given, the market rally. And I've gotten a lot of questions around kind of why the interest in hedging now versus last year when the market was actually selling off. And I do think a big part of it is positioning, right? People have capitulated to this soft landing view. We're seeing leverage really start to build. Institutional investors really start to increase their allocation to equities, systematic strategies increasing their allocation as well. So as leverage builds, that's when you could potentially get, that convex move in volatility. And I think that is driving a lot of that interest in those VIX upside calls.
So, Mandy, we're looking at two worlds. One where things are relatively calm, you just described it, and it's reflected in the VIX. Another one, whether it's in rates or in FX, where people are seeing major relative price changes. John mentioned dollar stronger 9 weeks in a row. We've seen what has happened to U.S. rates relative to the rest of the world. Can we live in this two-world world, or at some point do we see convergence? And what does that convergence look like?
That's a great question. Can we live in this world? We've been living in this world for about 2 years now, where we've had elevated rates of volatility and relatively more subdued equity volatility. And what I would say is, that divergence is only a mispricing if you think the volatilities in each of these asset classes reflect the same risk. And I would argue they actually do not, right? Rates volatility is really a function of policy outlook uncertainty. And as we stand today, there's still a lot of uncertainty of whether, ultimately terminal rates going to end up, right? Could we see rates, Fed taking rates above 5%, 6%? Yes, absolutely. Could they, be cutting rates if economic situation turns? Absolutely. But I think for equities and for a lot of risky assets, what really drives volatility in those asset classes is the risk of recession. And that has undeniably gone down over the past year as we have seen, labor market data hold up and inflation come down. So I think that's what is driving it. And then specifically with the VIX, I would just say, given that it's a 30-day measure of implied volatility in the S&P, it's much more catalyst-driven rather than a gauge for long-term recession risk.
I'm pleased you mentioned that number 30. I want to talk about this one, 0. Mandy, just briefly, 0 day to expiry options. We've had a long conversation about that over the last 12, 18 months. Mandy, there's a lot of volume there, an explosion in volume coming out of the pandemic. From your perspective, does high volume equal high risk?
No, it does not. And I think that's the source of the misunderstanding in this product, right? So yes, 50% of option volumes in S&P is going through these 0 day to expiry options. So people often quote the notional number, 500 billion a day trade in these 0 DTE products. But what matters at the end of the day is the net balance between buys versus sells. If everyone is chasing, one side of the trade, then potentially, yes, that could pose risk. But if the flow is evenly split between buys versus sells, then at the end of the day, the net risk to market makers hedging those positions is very minimal. And what we see, and again, at SIBO, we see all this flow, right? All these options trade on our exchange. And what we see is that the flow is remarkably close to 50-50. And that at the end of the day, the net risk to market makers having to hedge those options, we're talking about, 0.1% of the S&P daily liquidity. So this is not a case of the tail wagging the dog at all.
Mandy, appreciate the update. Mandy Zhu there of SIBO. Mohammed, let's talk about this market more broadly. You remember the days when we had zero rates, we had QE forever, and people would come on programs like this one and say, we can't possibly go back to 5%. This is what the market is built on now. I take Europe as an example. I never thought we'd go to 4% over the ECB. I thought it was a potential in the pandemic that we'd never see a rate hike from this ECB for the next cycle, never mind the last one. And here we are. Do you think we can adjust and have adjusted to these high rates?
So far we've adjusted remarkably well. Remember, it's a trilemma. How do you reduce inflation without pushing the economy into recession and without causing excessive financial volatility? And so far, in the US, we have achieved all three. So far, so good. However, remember, especially if rates stay higher for longer, there are things that have to be refinanced in this economy that cannot be refinanced in an orderly fashion at these rates. So this is not something that happens instantaneously. It's something that happens over time. Now, in the UK, because the mortgage market has such short duration, it happens very quickly. Here, it happens more slowly. And that's why the long bit of higher for longer is really important. How long is longer?
So the effective rate on mortgages right now in this country is 3.6%. Torsten's Lock of Apollo put out some work over the weekend, and I'm sure you're familiar with it. Ultimately, at origination, I think about 10% of the mortgage market's paying above 6%, so we're just not there yet. And to your point, because it's 30 years, it could take a long, long time. I'm thinking more specifically about high yield. Is there a spot on the calendar where corporations below a certain grade are going to come to market and they're going to have some problems?
Yes. I mean, if you look at high yield, if you look at commercial real estate, massive refinancing needs next year. Massive. So that's the point of pain that starts to happen. Now, some people will tell you there's lots of distressed credit funds with lots of money waiting to come in. And we're going to see a game of chicken between the two. That's what we're going to see.
Is that the story for next year or the year after?
I think it's the story for next year. And we've got to be really careful. That's why the minute the market starts pushing back rate cuts, and it hasn't really pushed it back, but the minute it starts pushing back rate cuts, the conversation gets a lot more interested in various segments.
And more data like the data we've had this week, and maybe we go in that direction. Mohammed, stick with us. Coming up, looking ahead to a Fed rate decision.
I think they'll be inclined to deliver a hawkish pause. If you look at the underlying trends, core inflation is moving in the direction they want. So I think what we'll see next week is a pause, but an indication that they're prepared to do more.
Chair Powell taking center stage in a busy week for monetary policy. That conversation up next.
I think they'll be inclined to deliver a hawkish pause. They have gotten good news on inflation. Yesterday, a mixed report, but if you look at the underlying trends, core inflation is moving in the direction they want. So I think what we'll see next week is a pause, but an indication that they're prepared to do more. And I would expect them, I think it's finally balanced, but I would expect them probably to get one more hike in this cycle.
Former Fed Vice Chair Richard Clarida on the Fed's next move. The September FOMC meeting kicking off next Tuesday, leading a busy week ahead for policymakers with rate decisions coming from the Bank of England and the Bank of Japan. Mike McKee has more. Morning, Mike.
Morning, John. We're all traveling next week. I get to go to Washington. You get to go check on the Bank of England. Maybe we should meet in Tokyo when we're all done, because it is a big week with three central banks who have the same problem, inflation. And the Japanese have actually joined that party. Take a look at the inflation rates in all of these countries. You can see the Bank of England's problem. They have a very large inflation problem. The U.S. has made a lot of progress, but we just ticked up a bit. So does the Fed raise rates? The betting is they probably will. And the Japanese are now above zero and have been there long enough. And the odds are they're going to keep inflation high, according to the latest forecast. So they may start tightening policy a little bit as well, which leads us to what's going to happen in the markets. Well, the bet is nothing from the Fed, even though Rich Clarida was suggesting a hawkish pause. Nobody thinks they're actually going to hawk out and raise rates. About a 3.8% chance, as you can see. There is a bet, a strong bet on the Bank of England moving, and now there's a bet on the Bank of Japan. We haven't had that in a very long time. What do all three of these have in common? The U.S. dollar. The dollar has been strengthening because the Fed keeps raising interest rates, and because the U.S. is the biggest economy in the world, it's affecting everybody else. You can see the impact on the pound, and you can see the impact on the yen. I reversed the yen so you could get an impression of what it's actually doing. It's getting weaker. And that's a question for the Fed. Do they care? They care. They don't want to hurt other people, but their job is the United States. So expect the dollar to stay strong for now, and it's going to have an impact on the rest of the world. I guess you have somebody sitting with you who has a pretty good handle on cross-currency issues for people who work in two parts of the world.
That's a question for Mohammed, Mike McKee. Mohammed, have we got a dollar problem for all these central banks?
So in the past, whenever we've seen a very sharp appreciation of the dollar, it has tended to break something. What I thought was really interesting from Mike's comments is the Bank of Japan. I don't think the potential for the Fed to surprise is very large. It will keep rates unchanged, nor do I think the potential for the Bank of England to surprise is very large. It will raise 25 basis points. The big uncertainty is the Bank of Japan. And that is what I think markets haven't understood. It's not as much rates as the yield curve control. Do we get another signal that they are easing out of yield curve control territory?
Well, where do you think they are now? What is the actual policy on yield curve control of the BOJ?
So they're tolerating a 70 basis point 10-year,
yeah,
which was unthinkable 6 months ago. And I think they may indicate that they're willing to tolerate something more, and the rate will move immediately on that news.
Governor Wade has suggested that maybe they do raise interest rates at the end of this year and abandon negative interest rate policy. Do you think we should be paying attention to that as well?
We should absolutely be paying attention, not because of the rate spillover, but because the Japanese are very big owners of foreign securities.
Okay, so the next question is, what does that mean for treasuries? So the anchors have gone now. Put the market away. ECB is done with all of this. Bank of Japan set to follow potentially, given what you've just said. Does that mean a new floor for treasuries or a new ceiling for treasury yields?
So first, the policy anchors have gone away. Okay, the economic anchor is still holding in the U.S. That's really important. It's important for the U.S. It's important for the rest of the world. And then there are the technicals. The good news for most market participants is that the technicals are favorable. Keep a very close eye on the 10-year if it gets to 0.35, 4.35. That is a major resistance point. And if it goes through there, then people are going to start talking about 450, 475, and it's going to be a different narrative.
Interesting. 433 right now, by the way, on a 10-year Treasury. Mohammed, stick with us. Coming up on the programme, I'll run you through the trading diary, the calendar for the week ahead. From New York, this is Bloomberg. Let's get to the calendar. The week ahead looks like this. At the top of the hour, UMich Consumer Sentiment Survey Plus. President Biden expected to address the UAW strike later today. Wednesday, Fed rate decision, pound news conference. Thursday, the Bank of England's turn. And finally, on Friday, it's the BOJ. Mohammed with us around a table in New York. Mohammed, what a week.
What a week. And next week will be also what a week.
What stands out for you this week?
4 things. U.S. growth exceptionalism. 2, the return of some inflationary pressure. 3, Europe deep into stagflationary risk. And finally, Japan likely to exit YCC much quicker than most people expect. That is quite a combination for 1 week.
Stagflation, risk or reality in Europe?
I fear it's going to be a reality. I really worry about that, John.
That is brutal. It just looked terrible for them this week, didn't it? What's the answer? What's the policy response you should have when you confront that into next year?
So I know what the ECB is going to do. It's going to stick to its single mandate. I think policymakers have to do a lot more on the industrial policy side because they have to take advantage of this opening as a transition in the growth model, something that's absolutely critical.
Interesting. Mohammed, just fantastic to see you, as always. Thanks for being with us.
Thanks.
Mohammed Al-Arian from New York City. That does it for me. Have a fantastic weekend. Good luck for the rest of the trading day. This was the countdown to the Open. This is Bloomberg.